Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have George Hashbarger Jr. on the line. He's a portfolio manager for Quintium Advisors. George, how you doing on this Friday morning?
Hey, good morning. Thanks for having me, Joel. It's great to be here, and I'm looking forward to chatting with you guys today.
Okay, so just give us a little bit about your background and how you ended up as a portfolio manager.
Yeah, no, I'm happy to do that. So I've been a professional in finance and investing my entire career. Originally, I actually started in private equity with GE Capital and moved to the public markets about 20 years ago. And currently, we manage two different strategies. The BPV Wealth Preservation Fund, which is essentially a hedged equity strategy, and then a global macro strategy, which is the BPV Core Diversification Fund. So we've been, our primary goal right now is investing asset allocation, as opposed to, I was listening to some of your previous guests you had on this morning, and they talk about individual companies, and we generally think about big market trends and asset allocation, so a little bit different focus.
No, and that's why we love having you on here. So you've been in different aspects of the industry here, and along the way, I think you probably have learned different things about investing. At the various places, is there like a couple, hard, steadfast rules that you follow for investing that you could share with our audience?
Yeah, and I'd be happy to do that, Joel. And I think one of the biggest ones is very simply, one main lesson I've learned is just do the work. And simply what I mean by that is, we're believers of fundamental analysis. So we believe in process and doing high-quality analysis and not just shooting from the hip. And what we find is that always makes the decision-making process better and easier. And ultimately it gives you a better batting average, and that doesn't guarantee that you're going to make a good decision or a correct decision every time. But what that does is it gives you the best chance possible. And I've learned also then to make the distinction between the difference between a good decision and a good outcome. If you have a good process and you do good work, you can reach the correct decision given the inputs. You still may have a bad outcome. So we rely very heavily on good process and good decision making.
All right, so you're primarily fundamental analysis, but when you decide about the companies that you want to buy, do you go to the charts? Do you have technical analysis techniques you look at, or do you have other people in your company that you give that to?
Yeah, so interesting. So our funds, we really don't rely on technical analysis in any way. It's all fundamental. And the strategies that we currently run, we do not actually invest in individual companies. So we're looking at, we either use sector ETFs or larger ETFs on the BPV Wealth Preservation Fund that I personally manage. What we do is almost the opposite of what some of your previous guests do. Your previous guests are trying to look at individual companies and make an analysis and a bet on or investment on those, or even a trade. We're longer term in nature, and what we look to do is we analyze individual companies to look for bigger trends. So what we're interested in is, for example, over the past couple of quarters, things that have been interesting to folks have been, what is the impact of a strong dollar on either individual companies and or the market? What's the impact of falling oil prices? And then rather than look at it how that might impact an individual company from a buy or a sell perspective, what we do is aggregate that up into either sectors or markets and have longer-term views then on specifically the S&P 500.
Okay. Do you use the options market at all for your strategies? Maybe options on the ETFs, or are you just strictly into cash ETFs?
Yeah, no, so that's a great question, and we actually use options very extensively. So the Wealth Preservation Fund is a hedged equity strategy whereby we actually own just a single security long, which is the SPY, the biggest, most liquid ETF, and our whole view is expressed in owning that on an underlying basis, but then we use multiple option strategies, each strategy which has its own objective within the fund to help manage our exposure and then make tactical adjustments. So it's a risk-managed strategy. Long puts are a cornerstone of what we do, and the goal is to try to minimize volatility and drawdown relative to the S&P 500. But as volatility changes, we basically have three things that we look at. So we analyze and have an evaluation opinion on the S&P 500 itself. We look at the volatility market, and then we also look at the options market. And all of our tactical adjustments and trading really does then center in the options market as opposed to the indollar.
Being on the long put side as opposed to the short call side, taking in the premium, of when the market sits still, as opposed to being on the other end of that decay, is selling calls part of your strategy as well?
Yeah, yeah. So that's a great question. So the cornerstone of what we do, given is that long put, but you're absolutely right. There are other strategies that we use. So we do sell short calls. We do obviously use call spreads, put spreads. A collar is a big piece of what we do, and also what we call risk reversal, which is simply the sale of a short put and the purchase of calls. We like to do what we call the ratio risk reversal, which simply means when we're selling a put, we're actually trying to buy some multiple of number of calls more than one relative to the put that we've sold, and typically that range can go anywhere from 2 to 4 times. And what that allows us to do, given that we're a risk-managed strategy, is have a nice capture rate on the upside should there be a rebound. So we manage each of those positions individually. We evaluate them each day on an individual basis as to whether it makes sense are they doing the job that was intended within the portfolio. And then we look at a portfolio as a whole also to make sure there's positive expected value in the whole portfolio.
Don't you ever just get tired of buying those puts and say, it's just not worth it? This market just keeps going higher and higher. Do you ever, get that frustration that, if you didn't, have the hedge that, what, your expected return would be on your portfolio?
Well, so it's a great question, and so the investors the people that invest in our wealth preservation fund are in the fund and invested in the fund for the very reason that we do have those long puts.
Okay.
Having said that, the expected value of a long put is negative, and so how we think about that is that our job is to purchase the hedge in the most efficient and effective way possible, and that really depends on two primary views. What's our valuation view, and then also what is the volatility market. And the volatility market changes. I mean, even a VIX level at 20 in one period of time can be much different than VIX at 20, 2 or 3 years ago. So if I think about how the volatility environment has changed over the course of the last 3 years, let's just take a very simple 5% collar with a 3-month expiry on it, where you're buying a put that is 5% out of the money and selling a call that's 5% out of the money. A simple call. And that relationship, if you looked at that back in the middle of June 2013 or in the middle of 2013, that 5% collar was essentially a cash neutral trade. So great risk return profile where you could have full protection of your portfolio at a 5% down level, have the full benefit of a 5% up level over a 3-month period, which is from a probabilistic point of view a very attractive trade, and you would be able to do that on a cash neutral basis. If I fast forward you to today's market, if I try to put on that same 5% collar, the volatility environment has changed dramatically. Puts relative to calls have become much more expensive, and it's not that the absolute cost of puts has gone up so much. What's happened is that volatility in calls has just completely crashed. And that has to do with people's view of valuation and upside demand on calls. And so said differently, people are starting to believe that there's much less upside in the S&P than there has been historically. So you just don't get paid to sell that call that's now 5% out of the money. So we've actually adjusted the strategy in that we're selling calls that are now closer to the money, where we can collect more time value, but we're selling fewer of them, so we're not capping all of our upside. So to get back to your original question, we don't get tired of having those puts. That's the goal of the strategy that we have, but how we try to adjust and pay for them does change given both our valuation expectations and the volatility environment.
Okay, moving on here. You talked about the S&Ps here and the spider being lined out. Are there any ETFs on your buy radar right now?
Well, so from a sector point of view, we only use the S&P with regard to that. But again, if I think about sector analysis, obviously healthcare has had a fantastic run here and is at a point in time where we think that sector is due for a little bit of a pullback. The financials, on the other hand, have actually had a nice little run here. And we think that that's probably a good place to put some money. There was some great mortgage information that came out a couple days ago that seemed to indicate, and then most of the earnings that have come out, we just got through the financial earnings season part of the S&P 500 here in the last week or so, which was generally pretty good. Obviously, utilities have struggled given what's happened with interest rates, so that's obviously a place to avoid right now.
Okay. And just overall, I mean, I know you're pretty much buy side. You do some hedging. Have you trimmed any positions lately, or went a little bit higher percentage cash at all?
Well, no. So we stay fully invested. So what we have done in the fund, though, the fund does have the ability to adjust its exposure. Generally, our exposure can range anywhere from 20 to 50% market equivalent exposure. And that's based on either our fundamental analysis and view of the options environment. So we've definitely pared back our exposure here in the second quarter, given where we were in the first quarter, and that really has to do with our view of earnings estimates. It's really interesting what's going on with earning estimates, both for the year and first and second quarter as a whole for the S&P 500. And it looks like the second quarter is actually shaping up to be very, very similar to what happened in the first quarter. So if you look at total S&P earnings that were expected coming into the year, back in December for the whole S&P 500, it was originally 8% for the whole year. And if you fast forward to the end of March, by the first quarter, what had happened is that total earnings for the year had gone from a +8 to just a +1.7, primarily driven by downgrades in the energy sector. And the first quarter went from a +4 estimate to a -5. Ultimately, first quarter earnings came in slightly positive, so a beat, if you will, in total, up just about 1%. But in the meantime, what happened is that Q2, Q3, and Q4 earnings all were revised downward. So let's say you ended up with only a 1.6 growth for the year in 2015. And interestingly enough, it looks like Q2, the same thing is happening. We're getting a bit of a beat right now. Most of the companies that are reporting on a blended basis, it looks like we're going to come in at better than that -4.5 for the second quarter. But what again is happening is Q3 and Q4 are getting revised downward again, such that total earnings for the S&P are now viewed maybe up 1% for the entire year. And so that's where we think the valuation challenge is on a go-forward basis, that multiples are fairly full on a forward basis. We're roughly in the 18 times forward category. And so we think as a whole, it's much more, the risk-reward relationship in the S&P 500 is much less attractive this year than it was in the previous 3 or 4 years where you had low-hanging fruit.
Okay, moving on here. I mean, I guess not. You really don't short stocks. I mean, you have or ETFs. You have ways of doing it through the options market. So there's a lot of different ways to do that. What's your overall take on the broad market here? You're a long-term investor. We've had a lot of volatility here with Greece, China, a lot of different things going on. What's your overall take on the broad market?
Yeah, well, it's a great question, and I started down that path a little bit on your previous question. So we just think that the risk-reward relationship is less attractive than it has been historically, and that it's time just to be a little bit more cautious. We're not doom and gloom, and we're not calling for anything like that happened in 2008, but earnings are going to be challenged. And there's a couple of factors leading into that. There is a strong dollar, which was a challenge in the first quarter. And clearly, it abated a little bit in the second quarter, but a strong dollar has reemerged here in the third quarter since we started trading in that quarter, and so it will flow through. So most of the companies that we've listened to on the earnings calls this year, 75% of them are clearly talking about strong dollar headwinds, as long as they're in the S&P 500. You have another category, which is gas savings, and the impact of the decline in the price of oil. That's obviously hitting the energy sector very hard. And the gas savings really that was expected to show up in the consumer category, consumer discretionary, really hasn't materialized in any significant way. So it appears to us that most consumers are pocketing the gas savings and viewing it as a one-time bonus as opposed to a change in lifestyle. Now there was one small category where it did actually show up in the fourth quarter and the first quarter, and that was home improvement. So Home Depot and Lowe's had fabulous comps over the last couple of quarters because people were definitely, that was one category where the spending did ramp up significantly. The other piece is that volatility we expect volatility to increase again, and we had a volatility increase here in the end of June for just really a couple of days, and that was primarily initiated with the fears and talks with what was going on with Greece, but it really then did accelerate when China started having the difficulties they had in their market and began taking the actions that they were taking. But it really was not sustainable. We think that when volatility will pick back up again is when we get closer to the Fed liftoff. We'd been in that environment back in December, where the Fed liftoff at that point in time was viewed as imminent, meaning it could have happened as early as March, and certainly was expected to happen by June. And then Chairwoman Yellen made her comments after the March meeting, and the market basically realized that it was going to be later in the year. But we're now closing back in on that, where it's expected sometime between September and December. And again, you've got that's exactly at the same time that the earnings for the year are back end loaded. So if we come in flat in Q2 and Q3, to have positive earnings for the year in 2015, it's all going to be dependent on the fourth quarter, and that's exactly the time that the Fed is anticipated to be thinking about raising rates. So there could be 3 or 4 catalysts that could point to higher volatility sometime in the late third or early fourth quarter.
I know it's now this next question. I know it's hard just to give advice just like on the whole, but we have a lot of younger people that are just looking at the markets here. What for someone that's just getting out of college, has money to invest now, what words of advice would you have for them?
Yeah, well, so it's a great question, and it's basic fundamental information. One is if you're young, like as you posed the question, just start early. Save early, and just do it on a regimented and consistent basis. And the power of compounding over the long term will absolutely take care of itself. And from a long-term perspective, we're students of long-term economic history. There has never been a 20-year period in the S&P 500 that was negative. So, averaging down and just continuing to invest over the longer term absolutely makes sense if that's your horizon.
And what if you're getting ready to retire?
Well, so if you're getting ready to retire, that's a much bigger challenge, right? And that's one of the reasons the Wealth Preservation Fund is interesting, because what's happened in the marketplace since 2008 is that savers have been severely penalized in the form of lower interest rates. And so if you're coming up on that, it was anticipated, I can remember 10 years ago doing demographic studies, and there was lots of discussion about stocks were going to have a hard time because the baby boomers were going to retire, sell all their stocks, and move into fixed income. And obviously that hasn't materialized because you can't get enough out of fixed income to really meet your retirement needs now. So it's much more challenging for them. And so I think what you've had there is a reach for yield in terms of either dividend stocks or going down the credit curve with regard to maybe you've gone from investment grade to high yield and taken more risk. And so there I think you have to be a lot more careful because you don't have a chance to make it back. And that's exactly why the fund that we have right now, the Wealth Preservation Fund, is attractive to folks, is because it provides attractive risk-adjusted returns, but allows we manage drawdown and volatility so that you're not going, and we manage against tail risk so that we try very hard to avoid the big risks that were evidenced in 2008.
All right. We've been on the line with George Hashbarger Jr., Portfolio Manager for Quintium Advisors, giving us a much different perspective on the market that's always needed. Thanks a lot, George. We'll appreciate you coming on. We'll talk to you again soon.
Thank you, Joel. I enjoyed it. I appreciate it.